I bought my first share of stock in the spring of 1942. The United States was fighting a war in the Pacific. The headlines were terrifying. The macroeconomic outlook was bleak. If you had listened to the pundits, if you had listened to the experts, you would have dug a hole in your backyard and buried your gold. But I didn't buy gold. I bought a business. Since that day, over 80 years have passed. I have lived through 15 recessions. I have seen interest rates at 1% and interest rates at 20%. I have seen the invention of the atom bomb, the television, the internet, and artificial intelligence. And through all of that noise, through all of that chaos, one thing has remained exactly the same: human nature. The market has changed, the technology has changed, the speed of information has changed. The way human beings react to fear and greed has not changed by a single inch. In fact, you could argue that despite all our advancements, investors today are more emotional, more irrational, and more prone to stupidity than they were in 1942. This is the great paradox of our time. We have more data than ever before. A kid with a smartphone today has more financial information in his pocket than the Emperor of Rome had in his entire empire. Yet people are not getting smarter. They are getting more confused. They are trading faster, speculating more, and thinking less. People come to Omaha every year for the Berkshire Hathaway annual meeting. They treat it like a pilgrimage. They wait in line for hours. They look at me and Charlie as if we are oracles who can predict the future price of soybean futures or the next quarter's GDP. They want the secret sauce. They want the complex formula. They want me to tell them which cryptocurrency will go to the moon or which AI stock will triple by next Tuesday. When I tell them the truth, they are disappointed. The truth is boring. The truth is slow. The truth requires character, not just intelligence. I often say that investing is simple but not easy. It is simple because the math is fourth grade arithmetic. You do not need calculus. You do not need to understand beta or gamma or modern portfolio theory. In fact, if you know those things, it is probably better to unlearn them. But it is not easy. It is not easy because it requires you to go against the crowd. It requires you to stand alone when everyone else is running. It requires you to control the one thing that no school can teach you to control: your own emotions. Over the next hour, I am going to lay out the framework that built Berkshire Hathaway. I am going to explain the 5 rules that I have used to navigate 8 decades of financial storms. These rules are not suggestions. They are the iron laws of capital allocation. Why do I say that 99% of investors fail? I do not mean they lose all their money, though many do. I mean they fail to achieve their potential. They fail to secure their freedom. They spend their lives stressed, glued to screens, reacting to noise, and paying fees to helpers who know less than they do. They fail because they focus on the wrong things. They focus on the price of the stock, not the value of the business. They focus on next week, not next decade. They focus on being smart rather than being rational. I have known many people with high IQs who were terrible investors. I have known people who could solve complex differential equations in their heads, but who fell apart when the market dropped 10. Intelligence is an engine. It provides the power, but rationality is the steering wheel. If you have a 400 horsepower engine and no steering wheel, you are going to crash faster than the guy with the slow engine. The 5 rules I am about to share with you are your steering wheel. They are designed to keep you on the road when the fog is thick and the road is slippery. You must understand that Wall Street does not want you to follow these rules. The financial industry is built on activity. Brokers make money when you trade. Consultants make money when you shift strategies. The media makes money when you click on headlines about the coming crash or the next boom. If everyone followed my rules, the financial industry would shrink by 90%, because my rules are about inactivity. They are about patience. They are about silence. So shut out the noise, turn off the news ticker, forget about what the Federal Reserve might do next month. Let us step into the library of rationality. Let us look at the structure of wealth that lasts. It begins with the most fundamental rule of all, the rule that separates the gambler from the investor, the rule that protects you from ruin. Rule number 1, never lose money. Rule number 2, never forget rule number 1. I have quoted this thousands of times. It has become a cliche. People print it on T-shirts and coffee mugs, but very few people actually stop to think about what it means mathematically and psychologically. When I say never lose money, I am not speaking about daily fluctuations. If you buy a stock at $100 and it goes to $98 tomorrow, you haven't lost money. That is just the market breathing. I am speaking about permanent loss of capital. I am speaking about the kind of loss that you cannot recover from. I am speaking about ruin. In order to understand rule number one, you must understand the asymmetry of loss. The math of making money and losing money is not symmetrical. It is heavily weighted against the loser. Let's look at the arithmetic. It is brutal. Imagine you have a portfolio of $100,000. You make a stupid decision. You chase a hot stock and you lose 50%. You are now down to 50. The human brain instinctively thinks, okay, I lost 50%, so I just need to make 50% to get back to even. This is the great trap. If you make 50% on your remaining $50,000, you only have $75,000. You have to double your money just to fix your mistake. Do you know how hard it is to double your money? It takes years of patience, discipline, and luck, and you have to waste all those years just to get back to the starting line. This is why the first rule is survival. You cannot compound zero. If you take a sequence of numbers, returns of 20%, 30%, 15%, and you multiply them all together, you get a beautiful result. But if you insert a single zero into that multiplication chain, the entire result becomes zero. One catastrophic decision can erase a lifetime of prudent decisions. So how do we obey rule number one? We do not do it by being smarter than the market. We do it by demanding a margin of safety. The margin of safety is the cornerstone of value investing. It is the only concept that will save you when the unexpected happens, and the unexpected always happens. If you are an engineer building a bridge and you calculate that the maximum weight of a truck crossing it will be 10,000 pounds, do you build the bridge to hold exactly 10,000 pounds? If you do, you are a fool. You build it to hold 30,000 pounds. Why? Because steel can fatigue, because engineers make miscalculations, because some driver might overload his truck. You build in a buffer. That buffer is your margin of safety. In investing, this means price and value are two different things. Price is what you pay. Value is what you get. If I calculate that a business is worth $100 million based on its future cash flows, I do not buy it for $100 million. If I pay fair value, I have no margin of safety. If I am wrong about the growth rate, or if interest rates rise, I lose money. I wait. I wait until the market is depressed. I wait until there is fear in the streets. I wait until I can buy that $100 million business for $60 million. When I buy a dollar bill for 60 cents, I have a huge buffer. Things can go wrong, and I can still break even. If things go right, I make a fortune. The problem is most people hate to wait. They have cash in their pocket, and it burns a hole. They feel they must be in the market at all times. They buy stocks that are fairly priced, or worse, overpriced, because they are afraid of missing out on the party. They are driving across a bridge with no safety margin. When the wind blows, the bridge collapses. The second way people violate rule number one is through leverage. I have seen more smart people go broke because of leverage than any other reason. Leverage borrowing money to buy stocks is like driving with a dagger on your steering wheel. When you use your own cash, you can endure volatility. If a stock drops 50%, you can hold. You can wait for sanity to return. But when you use borrowed money, you do not have the luxury of time. If the market drops 20%, the broker calls you. He demands more cash. If you don't have it, he sells your position. You are wiped out at the bottom. In 1998, long-term capital management collapsed. These were the smartest men in the world. They had Nobel Prize winners. They had the highest IQs in finance. They had mathematical models that were supposed to be flawless, but they used massive leverage. They picked up pennies in front of a steamroller. When the Russian debt crisis hit, an event their models said was impossible, they were crushed. They went to zero. The janitor at the library who saves $100 a month and puts it in an index fund without leverage is a better investor than the Nobel Prize winner who uses leverage. The janitor survives, the genius goes broke. Never risk what you have and need for what you don't have and don't need. If you are already wealthy, or if you are on the path to wealth, why would you risk going back to zero just to get there a little faster? It makes no sense. It is madness. Rule number one is about defense. It is about staying in the game. because if you can just stay in the game for 40 or 50 years, the compounding will make you rich, but you have to survive the crashes. You must build a financial fortress that is impregnable. Well, that means cash. That means no debt. That means buying only when the odds are heavily in your favor. Once you have secured your survival, only then can you look for the specific opportunities. Only then can you move to rule number 2. Once you have committed to never losing money, you must decide where to place your bets. This brings us to rule number 2, the circle of competence. In the Olympics, decathletes are celebrated. We admire the athlete who can run the 100 meters, throw the javelin, and pole vault. They are generalists. They are versatile. But investing is not the Olympics. In investing, there are no extra points for difficulty. There are no medals for complexity. You do not get a higher return for analyzing a complicated pharmaceutical company than you do for analyzing a simple chewing gum company. In fact, usually you get a lower return because the complex company has more variables that can go wrong. Rule number 2 is about humility. It is about defining the perimeter of what you know and, more importantly, admitting what you do not know. My partner Charlie Munger and I have a very simple system on our desk. We have 3 boxes: in, out, and too hard. The in box is very small, the out box is distinct, but the too hard box contains 99% of the opportunities that the world presents to us. When the dot-com bubble was inflating in the late 1990s, people called me a dinosaur. They said I had lost my touch. They said I didn't understand the new economy. And they were right. I didn't understand it. I didn't understand how to value companies that had no earnings, no cash flow, and only promised to change the world. So I put them in the too hard box. I watched people make millions overnight in stocks I couldn't spell. It is not easy to watch your neighbor get rich doing something you don't understand. It triggers a very primal envy. It triggers the fear of missing out. But because I stayed in my circle, when the bubble burst, I didn't lose a dime. The people who wandered outside their circle chasing the hype lost everything. You have to understand that your circle of competence does not need to be large. You don't need to be an expert on real estate and tech and crypto and biotech. You only need to understand one thing very, very well. If you are an expert on local car dealerships and you understand that business inside and out, buy local car dealerships. If you are a pharmacist and you understand the drug pipeline better than Wall Street, use that edge. The size of the circle is not important. Knowing its boundaries is vital. The moment you step 1 inch outside your boundary, you are no longer an investor. You are a gambler. You are betting on luck rather than logic. My friend Ted Williams was one of the greatest baseball hitters of all time. He wrote a book called The Science of Hitting. In it, he divided the strike zone into 77 baseball-sized squares. He argued that if he waited for the ball to be in the sweet spot, a specific area the size of a grapefruit, he would bat .400. But if he swung at pitches in the lower corners, his average would drop to .230. Investing is exactly like that, with one major advantage. There are no called strikes. In baseball, if you don't swing at a strike, the umpire calls you out. In investing, the market can throw you a General Motors at Ford. You can look at it and say, I don't understand the car business, and you don't have to swing. The market can throw you a Microsoft. You can say, I don't understand software, and you don't have to swing. You can stand there with the bat on your shoulder for 6 months, waiting. The crowd might shout, swing, you bum. Your broker might scream, buy something, but you don't have to do anything. You wait for the fat pitch. You wait for the one opportunity that lands exactly in the center of your competence at a price that offers a huge margin of safety. And when that happens, you don't just swing. You swing for the fences. This is why diversification is often a protection against ignorance. If you know what you are doing, you don't need to own 50 stocks. If you own the best 3 businesses in your circle of competence, you don't need the 4th. The danger comes from ego. Highly intelligent people often struggle with this rule. They believe their high IQ allows them to figure anything out quickly. They read a few articles about blockchain and think they are experts. They read a report on lithium mining and think they understand the commodity cycle. This is hubris, and the market loves to punish hubris. I know my limits. I understand consumer behavior. I understand insurance. I understand capital allocation. I do not understand the future of microchips, so I stay away. It takes great discipline to say, I don't know. But I don't know is the most profitable phrase in an investor's vocabulary. It saves you from the mistakes that destroy portfolios. Define your circle, draw the line in the sand, and never ever cross it. Once you have defined your circle of competence, what are you looking for inside it? You are not looking for just any business. You are looking for a castle. This brings us to rule number 3, the economic moat. Capitalism is a brutal sport. It is nature red in tooth and claw. If you have a profitable business, it is like you have built a beautiful castle filled with gold. The moment you build that castle, competitors will start marching toward you. They want your gold, they want your customers, they want your margins. They will try to copy your product, undercut your price, and steal your best employees. Every business is under constant attack. Most businesses eventually fall. The walls are breached, the gold is plundered, and the company fades into irrelevance. To survive and to thrive for decades, a business needs protection. It needs a deep, wide, alligator-filled moat around the castle. A moat is a structural, competitive advantage that cannot be easily copied. It is the thing that allows a company to earn high returns on capital year after year without competition driving those returns down. When I analyze a stock, I am not looking at the earnings of the last quarter. I am looking at the width of the moat. I am asking myself, how hard would it be for a competitor to take this castle? There are a few types of moats that I love. The first is the low-cost producer moat. If you can produce a product or service cheaper than anyone else and still make a profit, you are incredibly difficult to kill. Look at Geico. They sell insurance directly to the consumer. They don't have thousands of expensive agents and offices. Their costs are lower. Because their costs are lower, they can offer lower prices. Because they offer lower prices, they get more customers. It is a virtuous cycle that acts as a formidable defense. Look at Costco. They operate on razor-thin margins. They are efficient machines. If you try to compete with Costco on price, you will go bankrupt before they do. That is a moat. The second type of moat is the share of mind moat, or the brand. Coca-Cola is the ultimate example. If you gave me $100 billion and told me to destroy Coca-Cola, I would give you the money back and tell you it cannot be done. You could build factories, you could hire trucks, you could make a brown fizzy liquid that tastes exactly like Coke, you could even sell it cheaper, but you cannot replicate the 100 years of history. You cannot replicate the feeling people have when they open a cold bottle on a hot summer day. You cannot replicate the association with happiness. Coca-Cola owns a piece of the consumer's mind. That is a moat that is almost impossible to cross. Then there is the switching cost moat. This is when it is too painful, too expensive, or too risky for a customer to switch to a competitor. Think about the software that runs a hospital or a bank. Once they have installed it, trained their staff on it, and stored all their data in it, they are not going to switch just to save 5%. The risk of disruption is too high. They are locked in. That is a beautiful moat. But how do you test for a moat? How do you know if it is real? There is one simple test. It is the pricing power test. The single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to a competitor, you have a very good business. If you have to have a prayer session before raising the price by 10%, then you have a terrible business. Think about Apple. They can raise the price of the iPhone and people still line up to buy it. They are not buying a phone, they are buying an ecosystem and a status symbol. That is pricing power. On the other hand, look at the airlines. If one airline raises its ticket price by $20, people will immediately go to a website and book the cheaper flight on another airline. They have no brand loyalty. They have no pricing power. It is a commodity business, and commodity businesses are terrible places to put your money. I want a business that can charge more every year just to keep up with inflation without spending a dime on capital improvements. Investors often confuse good management with a good moat. They think a brilliant CEO can save a bad business. I have a saying, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. You cannot row a boat against the tidal wave if the business has no moat. If it is a commodity, even a genius cannot save it. I would rather put a mediocre manager in charge of a business with a great moat than a genius manager in charge of a business with no moat. The castle protects itself. So look for the moat, look for the unbreachable wall. because in the long run, the width of the moat determines the safety of your kingdom. We have built the fortress. We have defined our territory. But now we must face the enemy. The enemy is not the economy. The enemy is not inflation. The enemy is not the Federal Reserve. The enemy is staring back at you in the mirror. This leads us to rule number 4, master the market. Do not let the market master you. My teacher, Ben Graham, gave me the greatest gift of my intellectual life. It was not a formula. It was an allegory. He gave me the concept of Mr. Market. Imagine that you are partners in a private business with a man named Mr. Market. Every day, without fail, Mr. Market comes to your office or calls you on the phone. He names a price at which he is willing to either buy your interest in the business or sell you his. The problem with Mr. Market is that he is an emotional wreck. He is a manic, depressive. Some days he is euphoric. He sees only sunshine, endless growth, and rainbows. In his mania, he offers you a price for your shares that is ridiculously high. On those days, he is greedy. Other days, he is deeply depressed. He sees only storm clouds, war, and bankruptcy. In his fear, he offers to sell you his shares for pennies on the dollar. On those days, he is terrified. Now, here is the mistake that 99% of investors make. They look at Mr. Market as an instructor. They look at the stock price on the screen, and if it is down, they think, the market knows something I don't. I should be scared. They let the price dictate their reality. Rule number 4 states clearly, the market is there to serve you, not to instruct you. Mr. Market's wallet is useful, but his wisdom is non-existent. You must look at his prices, but you must not be influenced by his moods. When he is foolishly greedy, you should sell to him. When he is foolishly fearful, you should buy from him. This sounds easy. Intellectually, it is 4th grade logic, but emotionally, it is the hardest thing you will ever do. There is a contagion of fear. It spreads like a virus. When you turn on the television and see red arrows everywhere, when the headlines scream crash, when your friends are selling, your biology screams at you to run, you want to be part of the herd. It feels safe in the herd. But in investing, you pay a very high price for a cheery consensus. If you want to have a better performance than the crowd, you must do things differently from the crowd. You cannot buy what is popular and expect to do well. Price is what you pay. Value is what you get. The market is a voting machine in the short run, but it is a weighing machine in the long run. If you own a farm and the price of corn drops today, you don't sell the farm. You know the soil is still good. You know the crop will come back. Yet people sell their stocks, which are ownership stakes, in real businesses just because the price ticker changed. You need an emotional firewall. You need to insulate your mind from the noise. If you cannot control your emotions, you cannot control your money. This discipline is what allows you to execute rule number 5, the snowball effect. Albert Einstein is rumored to have said that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Investing is not about getting rich tomorrow. It is not about hitting a jackpot. It is about the slow, boring, relentless accumulation of capital over a lifetime. I call it the snowball. I started building my little snowball when I was 11 years old. It was very small, but I found a very long hill, and I found very wet snow, and I just kept rolling it. The nature of compound interest is that it is backloaded. The big numbers only come at the very end. If you double a penny every day for 30 days, on day 10 you have a few dollars. It looks pathetic. You feel like you're wasting your time. On day 20 you have a few $1,000s. It still doesn't look like much compared to the effort, but on day 30 you have over $5 million. Most people stop at day 10. They get bored. They get impatient. They interrupt the process. They see a shiny new object. They sell the great company because it hasn't moved in 6 months. They cut the flowers to water the weeds. Rule number 5 requires a quality that is almost extinct in the modern world, lethargy. I am often accused of being lazy, and it is true. I buy a stock, and then I do nothing. I do not trade. I do not rebalance constantly. I do not watch the ticker. I sit. Inactivity strikes us as unintelligent behavior. We are taught that don't just sit there, do something. But in investing, the rule is Don't do something. Just sit there. The money is not made in the buying and the selling. The money is made in the waiting. I have a mental model that helps with this. It is the 20-slot punch card. Imagine that you are given a punch card with only 20 slots. Every time you make an investment decision, you punch a hole. But here is the catch. When you have punched 20 holes, you are done. You can never make another investment for the rest of your life. Under those rules, would you buy a stock just because a guy at a party recommended it? Would you buy it just because you saw it on CNBC? No, you would think about it for days. You would research it deeply. You would only act if you had absolute conviction. You would load up the truck and you would hold it forever. That is how you should invest. You should act as if you have a finite number of decisions, because you do. Time is the friend of the wonderful business and the enemy of the mediocre. If you are in a good boat, just stay in the boat. Let the current of compounding carry you. We have walked through the 5 rules. Never lose money. Stay in your circle. Find the moat. Master the market. Let it compound. These rules are simple. They are not secret. I have been publishing them in my annual letters for 50 years. Anyone can read them. So why do 99% of investors still fail? They fail because they are playing the wrong game. They are focused on the outer scorecard. The outer scorecard is how the world sees you. It is your neighbor admiring your car. It is your colleagues admiring your clothes. It is the need for validation, for status, for immediate applause. When you invest for the outer scorecard, you buy what is popular. You buy what makes you look smart at a cocktail party. You use leverage to get rich fast because you want to show off. You are a slave to the opinions of others. But the 5 rules I have given you, they require an inner scorecard. The inner scorecard is a standard you set for yourself. It is the quiet confidence that you are right even when the whole world says you are wrong. If I do something that the world thinks is stupid, but I know it is smart, I am happy. If I do something the world thinks is smart, but I know it is stupid, I cannot sleep. To be a great investor, you must be comfortable standing alone. You must be comfortable being bored. You must be comfortable looking like a fool in the short term to be a winner in the long term. This brings me to the final point, the point that is more important than money. You can accumulate all the wealth in the world. You can build a snowball the size of a mountain, but if you do not understand what the money is for, you are poor. I have known many billionaires. I have dined with them. I have done business with them. Some of them are the most miserable people on earth. They have the outer scorecard, but their inner scorecard is empty. Their children despise them. Their spouses tolerate them only for the inheritance. They are lonely, paranoid, and unhappy. That is not success. That is the ultimate failure. When you get to my age, you will measure your success in life by one simple metric: how many of the people you want to have love you actually do love you. You cannot buy love. You can buy sex. You can buy testimonial dinners. You can buy buildings with your name on them. But the only way to get love is to be lovable. The 5 rules of investing are actually rules for life. Rule 1, don't lose your reputation. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Rule 2, know who you are. Don't try to be someone else. Stay in your circle of competence, in your career and your relationships. Rule 3, build a moat around your character. Protect your integrity. It is your most valuable asset. Rule 4, don't let the world's moods dictate your happiness. Be rational, be kind. Rule 5, compound good habits. Be a little bit wiser, a little bit kinder, a little bit more generous every day. If you do these things, the money will take care of itself. And more importantly, you will have a life worth living. Investing is a journey. It is a marathon, not a sprint. The finish line is not a number in a bank account. The finish line is peace of mind. So go out there, be rational, be patient, build your snowball, but never forget that the most important investment you will ever make is not in a stock, it is in yourself. Thank you for listening. Welcome to the minority.